This piece of paper represents a $300,000 subprime mortgage from 2006. 2 years after a loan like it was signed, it helped produce the largest bankruptcy in American history, $691 billion, filed at 1:45 in the morning. To see how one home loan connects to that, you have to watch what Wall Street built on top of it, a machine that relabeled risk at every step and removed it at none.
Start at the bottom. In 2006, a family signs for the house. Subprime means their credit or income paperwork wouldn't qualify for a standard loan. The common structure was a 228, 2 years at a fixed starter rate. Then the rate floats for 28. If the floating payment gets too heavy, the plan is to refinance, which works as long as the house is worth more than the loan. The lender isn't planning to find out. It sells the loan within weeks.
Here, the real machine picks up loans, like it, and we can watch an actual deal do it because the government's crisis inquiry later reconstructed one, buyer by buyer. New Century, one of the biggest subprime lenders in the country, made mortgages using borrowed money. Credit lines from Morgan Stanley, Barclays, Bank of America, Bear Stearns. On August 29, 2006, Citigroup bought a pool of 4,499 New Century mortgages for about $979 million. The deal's name was CMLTI 2006 NC2, our specimen.
Citigroup didn't keep them either. It placed the loans in a trust, a legal box whose only job is collecting the monthly payments, and sold slices of that payment stream to investors. 19 slices, stacked in strict order. Each month, the pooled mortgage payments pour in at the top. The top slices get paid first. The bottom slice gets paid last and eats the first losses. That ordering is the entire trick. The top slices sit so far from first loss that the rating agencies stamped them AAA, the same grade as a United States Treasury bond. In this deal, 78% of the stack was rated AAA. 21% sat in the middle. 1% was the crash pad at the bottom.
Real institutions bought these slices. Fannie Mae took the entire top slice, about $155 million of it. The Federal Home Loan Bank of Chicago bought in, so did a Kentucky pension fund, banks in France, Germany, Italy, and China, and a hospital. None of them thought they were buying a bet on subprime borrowers. They were buying AAA.
But the middle slices, the ones rated single A, triple B, were hard to sell. Too risky for pension rules, too dull for hedge funds. So Wall Street built a second machine to eat the leftovers. Take the unwanted middle slices from dozens of deals like ours, pool them, and slice the pool again. That's a CDO, a collateralized debt obligation, a box built out of other boxes' leftovers. And here is the step where you should stop nodding. About 80% of that new stack got stamped AAA too. Slices born BBB went in, AAA came out the top. The model said pooling many different mortgage bonds spread the risk. But these weren't different bets. They were the same bet, American house prices, placed in 50 states at once. Nothing was removed at any step. It was relabeled.
One more detail about those stamps. The rating agencies weren't hired by the buyers of the bonds. They were paid by the banks assembling the deals, the same banks that needed enough AAA paper for each deal to work. The referee was on the organizer's payroll. Remember that. Next, the insurance. A credit default swap is a contract. You pay me a small premium every year, and if that bond stack goes bad, I make you whole. The biggest seller was AIG, through a London-based unit called AIG Financial Products. By the end of 2007, AIG had written this protection on $527 billion of assets, including $78 billion tied to those CDO stacks. Ordinary insurance law forces an insurer to hold reserves against claims. These contracts weren't regulated as insurance, so against that book, AIG set aside almost nothing. Premiums in, nothing out. AAA doesn't fail. But buried in the contracts was a tripwire.
if the insured stacks lost market value or if AIG itself got downgraded, AIG owed cash collateral immediately. Not when the bonds defaulted, the moment prices moved.
Last piece, the warehouse. The banks that built this machine also held big pieces of it. Lehman Brothers, the fourth largest investment bank in America, had piled up over $100 billion in real estate assets and mortgage securities by the end of 2007, on a balance sheet of roughly $691 billion. Its leverage was about 40 to 1. For every $40 of assets, about $1 of Lehman's own money. A 3% drop in asset values would erase the firm. And the funding was borrowed overnight, renewed every morning for as long as lenders trusted the collateral. So there's the whole machine. Loan, pool, stack, restack, insure, leverage. Every layer priced on the same single assumption. American house prices do not fall everywhere at once.
In April 2006, the foundation cracked. The Case-Shiller National Index, the broadest measure of American home prices, peaked and turned down. Over the next years, it fell by roughly a third. Now run the machine in reverse. The family starter rate expires, and the refinance escape hatch needs a rising price. The price is falling. Loans made in 2006 and 2007 went bad faster at every age than any batch before them. Less cash pours into the top of the waterfall, and the drought works from the bottom up. The 1% crash pad goes first, then the middle slices run dry. The exact slices the CDOs were built from.
In July 2007, with national prices down only about 4%, Moody's began mass downgrades. By 2008, every slice of the Citigroup deal we followed had been downgraded. Across the market, of all the mortgage-backed securities Moody's had rated AAA in 2006, 73% were eventually cut to junk. And a downgrade isn't just embarrassing. Pension funds are forced to sell. Banks have to hold more capital against what remains. And over at AIG, falling prices and downgrades pulled the tripwire.
By September 2008, nobody could say what the stacks were worth, which meant nobody could prove which banks were solvent. Overnight lenders started saying no. On September 7th, the government seized Fannie Mae and Freddie Mac, the two giant mortgage companies. The next weekend, regulators and bank chiefs spent 2 days trying to find a buyer for Lehman. The closest bid, Barclays, fell through. At 1:45 a.m. on Monday, September 15th, 2008, Lehman Brothers filed for bankruptcy. Roughly $691 billion in assets by the inquiry's count. The largest failure in American history.
The same day, all three rating agencies downgraded AIG, and the collateral demands jumped by $8.6 billion in 3 days. Cash AIG did not have. On September 16th, the Federal Reserve stepped in with an $85 billion credit line. The government's total commitment to AIG eventually reached about $182 billion. The same day, a giant money market fund holding Lehman debt broke the buck. Its $1 shares became worth less than $1, and the panic reached ordinary savers. Within a month, the market for short-term company borrowing shrank by $264 billion. The machine hadn't just broken, it had seized.
Now, the honest part, because the record and the legend differ. The official inquiry concluded this crisis was avoidable. Risky lending, failed oversight, reckless leverage. But its own commissioners published dissents. One blamed government housing policy, another saw a global credit bubble with many parents and no single villain. And a later post-mortem found something the popular retelling leaves out. Ordinary AAA mortgage bonds mostly held up. Through 2013, average losses on AAA mortgage securities were about 2.3 cents on the dollar. On the AAA slices of subprime deals, less than half a cent. The catastrophic failures concentrated exactly where the relabeling was thickest, in the CDOs, the lower slices,
and the leverage and overnight funding wrapped around them. The machine didn't fail because every label was a lie. It failed because no one could tell which labels to trust, and the entire system was borrowing overnight against being trusted.
The bill was real. About 8.8 million jobs disappeared between the end of 2007 and early 2010. More than 6 million households lost their homes to foreclosure. Congress authorized $700 billion for the rescue fund. $443.5 billion actually went out the door, and after repayments, the final lifetime cost came to about $31 billion. And the family from the beginning? Nobody in the chain ever thought they were holding that family's risk. The lender sold it. The bank sliced it. The agency stamped it. AIG insured it. Lehman financed it overnight. What the machine really manufactured was distance between the house at the bottom and whoever would finally take the loss. When prices fell, all of that distance collapsed in a single night.